You've worked for a long time and diligently saved in order for you to be able to get to and enjoy retirement. And the last thing you want, and I would bet most people want, is for the IRS just to leave them alone and not cause any more damage than they already have. And let's be real, for a lot of us, the IRS is an afterthought. We work, we earn money, we pay our taxes, and that's it. However, once you get to retirement, specifically if you've been somebody who's saved a lot in tax deferred accounts like 401ks, the IRS and the future rates at which they apply income tax could have a significant impact, for good or bad, on your future retirement viability. Hi, my name is Derek Delaney. I'm a certified financial planner, and these are the type of conversations I have with my clients for a living. So, if you think of all the money you have saved in your 401k, let's use $1 million for example, and it's all inside the deferred end of your 401k, which means you, over a long period of time, have slowly contributed to that account. All of the money you put in that account has been pre tax, meaning that money has not been taxed yet. So you've been able to pre-tax contribute to that account. All of that money has grown tax deferred, which means when you take that money out at some point in the future, it will all be taxed as ordinary income. Great. Well, Derek, the idea was while I'm working and earning more money, I avoid paying tax on those dollars. I put that money in a traditional 401k. And then when I get to retirement and I'm making less money, I'll be in a lower tax bracket where I can then withdraw those dollars, finally pay tax on it, but at a lower rate than I would have while I was working. In theory, it makes sense. In real life, it doesn't work out that way 100%. And for those that it does not, the punitive tax liability that you take on could be significant. And that's where a lot of tax planning comes in, where you could look at the future taxation of your money, specifically how much of that money you think you're going to spend and when, and map it out and go, maybe it makes sense to start doing Roth conversions to accelerate some of the tax liability in that 401k. So when I get older, I don't have as much risk in regards to the IRS increasing tax rates and them owning a bigger share of your retirement nest egg. So you do those Roth conversions to keep that risk of higher taxes in the future from happening. The biggest reason why Roth converting money now to avoid future enhanced tax liability is because of the required minimum distribution rule. And what that is, the IRS's way of forcing you to withdraw money from your retirement accounts, whether you need that money or not, by the time you reach a certain age. And as of this recording, that specific age is 73. So if you save a lot of your money in a 401k and you're slowly withdrawing that money because you don't need a lot, and that account balance inside that 401k or IRA once you get to retirement continues to grow, there is going to be a point where you're going to be forced to start taking money from that account, whether you like it or not. And for a lot of people, like I talked about before, is age 73. And the amount of money you're forced to take out of that account is what the balance of that account is on December 31st, the year prior, divided by how long the IRS thinks you're going to live at age 73. And then every single year after that, they take 1 year off of the denominator. So if your account balance continues to grow after age 73, and the IRS thinks the likelihood of you living becomes less and less as you move forward, the numerator gets bigger, the denominator gets smaller, which means those required amounts continue to grow. And again, you're forced to take that money out, and you're going to be taxed on that money as you get older, as you need that money less. And if IRS raises tax rates moving forward, those future RMDs could be extremely punitive because it's money you're being forced to take out at potentially higher tax rates if rates go up when you don't actually even need the money to live off of because of your age and your spending capacity at that time. Which is why Roth conversions can be unbelievably valuable early in retirement before RMDs kick in. Let's look at a real world example. So in this example, I have a couple who plans to retire at age 65. They're going to retire with about $2.5 million, and the majority of that is in tax-deferred 401k accounts, meaning that money is subject to future higher taxation if income tax rates go up in the future. So we look at what is the benefit of spending all their tax deferred money first, up to what their spending levels are each year, or converting up to the 22% bracket. In this example, over a long period of time, the total taxes saved by implementing Roth conversions is almost $1.5 million, and total net legacy increase is almost $1.5 million in present value terms. So there is significant benefit in doing a Roth conversion. And if you see here, that significant benefit is not realized early in retirement, where this yellow line signifies the amount of tax paid due to those Roth conversions earlier in retirement compared to only spending what they need to out of those tax deferred accounts. And you can see here the Roth conversions are more punitive from a tax standpoint early in retirement. But once the majority of the money has been converted, as you can see here later on in retirement, their tax liability basically goes to zero because they have no taxable money left. It's all been converted into Roth IRA type of accounts. On the flip side of that, the tax deferred money is less punitive early on in retirement because you're only spending the tax deferred money up to what your desired spending levels are that year. And in this example, it's below the 22% federal income tax bracket. So the tax rates are lower. And then all of a sudden you hit that magic age where those required minimum distributions kick in. And whether you need the money or not, you are forced to withdraw that money out of your 401k or IRA accounts, causing huge tax liabilities later on in retirement because you're forced to withdraw that money, again, whether you need it or not. So you're paying the piper early on in retirement via those Roth conversions to keep you from having to pay significantly more amounts later on in retirement because of those required minimum distributions. And what do those minimum distributions look like later on if you don't do any Roth conversions? That is signified by this light pink color when it looks like, or when it's shown what you spend each year in retirement. You can see here the first handful of years in retirement, you're not spending a lot. There's not a lot of tax liability that you are incurring. But once you get to that RMD age now, the IRS is going to force you to spend money out of that account. And as the numerator gets bigger and the denominator gets smaller in that equation, the required amount you're supposed to take out grows every single year. And for most people, as they get older and they advance through their 70s and 80s, they don't need as much money to live off of as they could have in years prior. It doesn't matter. The IRS is forcing you to take way more money out than you need, typically, which means you're taxed on that money, which means that money that you're taxed on is going to throw you into much higher federal income tax brackets than those 22% Roth conversions we talked about before. And this gets really bad really fast if you get to a point in retirement in the future when those tax rates are now higher than what you projected them to be 5, 10, 15 years prior compared to where they were when you started retirement, which absolutely could be the case considering we are in historically low tax brackets today. So just know when you think about Roth conversions and you think about accelerating tax liability early in retirement, there should be a rhyme and reason for it. And for most people, it's because they don't want to take on those future tax liabilities that the required minimum distributions will force them to, especially knowing that those future liabilities could be far more punitive, especially if tax rates go up in the future instead of staying the same or going down. And then the last point is if you don't spend all that money yourself and you're able to convert a large portion of it to some sort of Roth account, your beneficiaries will be far better off inheriting that money because they will owe no tax on it compared to inheriting a lot of tax deferred money, which they'll be required to spend within a certain period of time, and they'll be required to take RMDs themselves, most likely, over that specific 10-year period that they have to withdraw the account. And if they're already in a high tax bracket because they're in the prime earning years of their life, when they inherit that money, it's not uncommon to think that the biggest beneficiary of your life's work of savings, if that were to pay out, would be the IRS because of the taxes owed via your beneficiaries having to withdraw those tax deferred monies while they're in the prime working years of their life, already earning a large income, which is pushing them already up into a higher tax bracket than you would have been in converting that money yourself earlier on in retirement. So Roth conversions are phenomenally valuable if your financial situation dictates they are. You have to do the math. You have to understand what your projected retirement spending is going to be long term. And then you have to have a conversation about what type of tax risk are you comfortable taking long term in retirement. And if it all leads back to doing Roth conversions, executing on that plan, reviewing it, and executing it again year after year can be significant savings. For some people, 7 figures, either with tax savings alone or when it comes to your overall net legacy for you or your beneficiaries. So it's something you absolutely want to consider, especially when you think about Roth conversions and comparing them to RMDs and what those future RMDs could be and how punitive they could be long term. If you're somebody who looks at that and you go, Derek, I don't want to pay the IRS more than I have to. I don't want my beneficiaries to have to pay the IRS more than they have to. I don't want the IRS to be the biggest beneficiary of my lifetime worth of savings if something were to happen to me. These Roth conversions sound valuable. What's my next step? The next step you should take is to schedule your free consultation, and I'd be happy to share more about how I implement tax planning and Roth conversion strategies into the overall retirement plan for my clients to give you a better idea of if that is something that could be valuable for you or not long term. So schedule your complimentary consultation using that link below. Until that future conversation, happy retirement planning.